thoughts and, of course, tell us what's in store for the market here on. Joining me is Alok Agarwal, who's Head Quant and Fund Manager at Alchemy Capital. Lovely chatting with you, Alok. First of all, wish you a very, very happy Diwali, season's greetings, and a great Summer 2082 going forward.
Yeah, happy Diwali to you and all your viewers as well. Pleasure being here.
Thanks a lot. Let's talk about the market then. Over the last 1 year or so, we've seen the market really test our patience, right? It really went nowhere, no big returns, and especially for investors who had gotten used to 20 to 25% kind of returns. Extremely flat, but now that the bulls are back, they started picking up traction at the right time, and in fact, we came very close to the all-time highs as well. What's your gut feeling? Do you think this leg of the up move that we have seen over the last 2-3 weeks is sustainable? And have we climbed all the walls of worry, given the fact that signs of thaw are also emerging when it comes to the India-US trade deal?
Yeah, Nandita, hi. You actually rightly pointed out what's happened in the last 1 year. Like it's been a major time correction. In fact, a lot of price correction in the broader markets as well. Uh, as we approach, if we see the start of the year as well, last 4 years after the COVID was so good, the markets and the earnings really compounded at a very good pace. But a lot of things changed after the Lok Sabha elections last year. And from capex driven expenditure, we started moving towards subsidies. There was a lot of tightening on the fiscal side. There was a lot of tightening on the monetary side as well. So, and at the same time, the monetary tightening was at the cost of maintaining the rupee. So, a lot of these decisions went against the overall economic growth. And we found that suddenly the nominal GDP growth itself also came down. We had multiple months of GST collections being in single digit growth itself. So those things had a big impact. And those numbers came at a time when the valuations of India were also pretty high. These things have got corrected largely over the last 1 year. In the last 1 year, while our markets are flattish, the global markets have really rallied. India has underperformed the world markets as well as the emerging markets by over 20% in last 1 year, which is a kind of a record number in the last 15, 20 years. And a lot of corrections have happened. So in terms of quality of expenditure also, from monetary tightening, we have come to liquidity easing. The CRRs have been cut, the interest rates have been cut, the system liquidity from deficit has turned into surplus. The earnings cut cycle is also almost like behind us. We are looking up towards the earnings growth also. So those numbers have started coming back in a much, much better way. As you rightly pointed that phrase, the wall of worry, it seems like we have more or less climbed that wall of worry. And it's just like the risk reward has started turning very attractive now. There are pockets of growth available at reasonable premiums as well. So that would be the view. Like we are positive, selectively positive on the segments that are offering visibility of growth.
Okay, before I come to those sectors that are offering visibility of growth, let's talk about foreign fund flows as well. They have been big sellers this year, right? But off late, the selling seems to have abated a bit. Do you expect a meaningful, pickup in FII flows here on, given the fact that you also mentioned that earnings have started to show green shoots, and we've seen that playing out in IT as well. We had fairly muted expectations. On the basis of that, numbers have been fairly okay, and banks have also been good. So, in terms of FII flows, do you expect them to return, given the valuation comfort it offers vis-a-vis other emerging markets, and of course also the fact that earnings are showing green shoot? Do you expect a meaningful recovery, and which are the sectors that could, be poised to see the most part of inflows, and one should position them before the influx?
So absolutely, certainly, we expect that the FI flows to start turning positive very soon. The last few days is just one of the recent examples. But we need to understand, a year ago when the majority of the outflow started, they found a market which was high on valuation. They found a currency which was overvalued, and they found a market which was like kind of going to see a downgrade in terms of earnings growth. So that was kind of a Goldilocks situation for somebody to exit. But those things have started turning completely upside down. So now FIs holding in India is at a multi-year low. The valuation premium of India versus the world as well as versus emerging markets has come down. versus emerging market is at a 10-year average, the premium, and the premium versus the world is actually below the 10-year average. So the valuation excess that was there, that has largely been cut down. The earnings growth cycle has been improving. The quality of expenditure has improved. The RBI, the central banker, has been very, very supportive of growth with liquidity measures right from the system liquidity to the rates. So a lot of those things have started turning around at a time when their holding, our FI holding in India is at a multi-year low. All this comes also at a time when India has majorly underperformed the emerging markets and world markets. The FI are underweight in India currently is at the lowest, is at the highest level, highest underweight that they have since 2009. So all these things look like it's poised for those numbers to come back. They also have a lot of shorts in the index futures, etc. Possibly it could be that first covering of those shorts, and thereafter you might see more buying on the cash levels. But on the whole, we see risk rewards improving massively, and I'm sure the FI is also taking note of the same. Possibly trade deal kind of events could be a catalyst in that movement. But nevertheless, the risk rewards improving, FIs would be kind of compelled to look at increasing their India allocations.
Okay, and which other sectors would you see IT and banks to be the big sectors where the bulk of the money flows? And should investors look at taking positions? A, because bank numbers, of course, have been fairly good, and even in terms of IT, numbers have been fairly okay with respect to low expectations. But valuations wise, IT, of course, has corrected quite a bit. So, are these the two sectors where one should get in right now?
In fact, both the sectors haven't done too well in the last couple of years. But as it is, India is a growth market, and growth is the area that FIs or any the institutional investor would want to go forward for. IT doesn't really promise, especially the large cap IT, they don't really promise of very high growth or at least substantially above the nominal GDP growth. So that's why our view on IT is very limitedly positive into those smaller companies which are offering higher growth. But in terms of banks and the financials, the whole gamut, right from banks to NBFCs to the capital markets are already doing pretty well. The banks and NBFCs are showing signs of bottoming out. We need to understand that the credit growth and the deposit growth in the system is standing at around 10%. Once we start seeing those pick up, especially possibly once we start seeing the impact of the GST cut numbers also on the finances, I'm pretty sure that those numbers are looking like bottoming out. A lot of steps have been taken by the RBI in terms of easing the lending rules also. A year ago, there was a lot of barriers put on lending for unsecured loans. Now those are easier. Now the banks can also participate in the M&A. So right from the unsecured loans, smaller ticket items to the large ticket items like participation in M&As, a lot of lending rules have also become easier. All this coming at a time when the growth numbers on the credit growth as well as the deposit growth has not been that great. So I would say banks and NBFCs and the whole financials look far better placed. On IT, our view is not very positive.
All right, got your point. In terms of banks as well, if we break it down between private and PSU banks, what would the preference be? Because in terms of PSU banks, if the government, of course, is considering higher FIR limits and valuations wise, they are better poised vis-a-vis private peers, and margins wise as well, we've seen the performance is much better. So tactically, would you look at PSU banks vis-a-vis private banks?
So it's been a rare occasion where both PSU banks and private banks look good. Typically, it has been a choice between the two, and more often than not in history, the private banks have won the race. As of now, both private banks and PSU banks offer good risk reward opportunities. But purely from a delta perspective, purely from a percentage return perspective, PSU banks are better placed. Most of these leading PSU banks, their net interest margins are at a multi-year high, their ROAs are at a multi-year high. And in fact, very interestingly, the credit cost of PSU banks as a cohort is almost comparable to the credit cost of private banks as a cohort, which has usually not happened. Typically, the credit costs of PSU banks have always been higher. So those numbers are pretty much in favor of the PSU banks as well. So we are positive on both, but we see a higher percentage gain possibility in PSU banks as of now.
Okay, got your point. Higher possibility of gains in PSU banks. But let's talk about the government's consumption kicker as well. How are you looking at consumption as a space? And I'm talking about it because, of course, HUL reported numbers yesterday, and the impact of delayed purchases and GST related adjustments was clearly visible in the numbers. Although the management said that the second half of the year will be much better compared to the first half. When do you really expect the actual demand to reflect in earnings? Would you expect that from this quarter itself, or would you say that we will have to wait for a couple of more quarters before it really shows up in the numbers of FMCG companies?
So within the consumption basket, we are not very positive on the FMCG side. We are more positive on the discretionary side. A lot of these FMCG companies, if you notice, even if you look at their operating income or the EBITDA, for the last 3 to 4 years, their EBITDA has been in a very narrow band. So for companies that are trading at maybe 40 times, 50 times a year ahead, if they grow at a pace which is substantially below even the nominal GDP growth, the growth versus valuation metric doesn't really work or doesn't really provide great risk reward opportunities. But the same is not true for discretionary. The discretionary side, some of them are trading at a higher valuation, but the growth numbers are also pretty good. And in both these spaces, we also have a lot of platform companies emerging who are taking a nice pool of revenues as well as great share of the pool of profits as well. So those platform companies also we are very positive. Some may want to classify it as tech, some may want to classify it consumption, but we do see that as a good delivery of consumption related goods there. So we are positive on consumer discretionary, both goods and services, as well as the platform companies. Within consumer discretionary as well, barring especially those watches, jewelry, as well as cars, etc. Even other items like consumer discretionary services also includes the travel side, also includes the saving side. So that's why the capital market plays are both the financial plays as well as consumer discretionary savings plays. And the travel side, be it the aviation or the hotels or the platform companies there as well, we are quite positive on them, and some of them are actually showing pretty good growth as well.
So, okay, that was on the consumption side. But what about defense manufacturing itself? We've seen a lot of clearances coming through from the Defense Acquisition Council or the likes of PSU names like HAL, BEL, or winning large orders. But where are you in terms of valuations when it comes to these names? Because they have already seen a fair bit of run up, and some experts have also pointed out that the next 5 years of growth may already be in the price. Would you concur with that view, or would you say that there could be still some room as more and more of these orders trickle in? And which end of the defense pack would you look at? There are some private names, smaller names as well. Do you see more room for growth there? How are you looking at the entire defense universe?
So let me break it up into the near term as well as the longer term. So near term, you also spoke about manufacturing, industrials, and defense. So, if you look at this year, start of the year through the budget, the government had given the bonanza in terms of direct tax cuts. From September, they gave the benefit of indirect tax cuts also. So a lot of boost coming from that side. So in a slowing economy, the economy has not grown at a great pace. In such a case, they need to balance out their expenditure as well. So either they continue with the capex and ensure that the fiscal deficit expands a bit, or they continue to go for fiscal consolidation, wherein the capex can take a slight hit. So far, they are maintaining their targets. Within the capex, two areas where it is very, very difficult to cut expenditure are defense and power. Both of them, they require their expenditure. If at all any capex cut has to happen, it has to happen in areas other than this. So that's why we are seeing this constant recurrence of defense orders being given. As far as defense is concerned, the geopolitical world in which we live now is very, very different from what it was maybe 5, 10, 15 years ago. Today, the expenditure of defense as a percentage of GDP that has been rising globally. Just to give you context, broadly speaking, the global GDP is around $100 trillion, and all countries put together, they spend somewhere around 2.5 to 2.7% of GDP as defense. We have seen in recent past that the US umbrella for even the NATO countries for security provision that has actually come off. all these countries have started increasing their own defense expenditure as well. India is uniquely positioned with not so friendly neighbors.
Hmm.
We need to also ensure, ensure that our own capabilities of defense goes up. A lot of import substitution has already happened. Just to give you the context, if the defense expenditure in the world today is around 2.5% of GDP, during the Cold War times, it was 6% of GDP. So we do expect that these numbers
Hmm.
of defense
Okay.
allocation as a percentage of GDP to rise globally. It's happening at a time when India is, instead of importing, is producing a lot locally. And especially in some of these operations Sindoor oriented fights itself, we showed some of our capabilities of this production as well. And some of the areas we'll be able to export to. So for me, or the way we look at defense is a multi-year opportunity. It could be a multi-decade opportunity as well. We almost link it to the kind of auto sector in the 1990s. The sector has just opened up. Today, we see predominantly the larger assembly
Hmm.
guys, the larger guys who are taking the orders, which are behaving like OEMs. As the sector starts seeing more and more visibility, we will be seeing lot more vendors, lot more ancillaries coming up. So we are positive on the overall sector. There would be volatility, but we would be buyers on dips there. The longer term visibility is pretty good, and the focus of the government is right there.
All right, a multi-decade opportunity, that's defense, and buying on dip should be the strategy. But there's been a lot in terms of, Russian oil purchases as well. And now we've had the Trump administration slapping sanctions on two major Russian oil firms as well, Rosneft and Lukoil. Just want to understand, your thoughts on oil PSUs in the wake of this. Of course, this also impacts margins, refining margins for the likes of IOC, HP, BP. Have you looked at this, and how are you approaching the entire oil basket in this light?
So there has been a lot of sound bites over the last few days regarding whether India would continue its purchases from Russia or
Hmm.
not. Obviously, all of us as market participants are also waiting for the trade deal to happen, and one of the major roadblocks for that is India's purchase of oil from Russia. Going by what the statements keep coming from the
Hmm.
media side, it seems like that India there has been some talks as well, and but we need to wait out for the real announcements as to whether India has promised it will cut down on the Russian oil purchases or not, and what is the actual tariff number that we're looking at. Coming to the sector itself, you mentioned about the OMCs.
Hmm.
Typically, these OMCs, they have a great business model in general, and the valuations are not too expensive. It is just that the visibility of their margins, the ability to pass on the prices, that all depends upon what the government positioning also is. So that actually inhibits us to really give the good visibility of growth for such companies. And in case of any untoward movement of the crude prices or maybe an impending election, lot of times we have seen that their margins take a hit. That actually stops us from taking a very good overweight or high position in such companies, and we actually kind of avoid that sector and maintain an underweight stance.
Hmm. All right, underweight on OMCs. Since you mentioned that, of course, there are media reports suggesting that the actual tariff rate may be much lower than the 50%. The recent report stated it could come as low, it could be as low as 15% as well. Something like that, would you say that that's not priced in and that could ignite a fresh leg of rally in the Indian market? In terms of what's digested in the market, would you say that a much lower rate has already been factored in, given the kind of up move we've seen in the recent weeks?
In fact, the majority of the underperformance India had in the last 1 year versus the global markets
Hmm.
actually came in the last 3, 4 months. The major part of that came in the 3, 4 months after the announcement of this
Hmm.
50% tariff. So I wouldn't really say that market is really
Hmm.
expecting or already discounting any kind of major cut in those tariffs. But it's quite speculative to say that what would be the final tariff. The numbers, as we understand, the number was 25 plus 25. That is, the additional 25 was for Russian oil purchases.
Yes.
So in case the deal breaker
Hmm.
was whether the India continues with Russian oil purchases or not. If they don't continue with purchase or slowly bring it down, from 50 to 25 looks like an easier
Hmm.
task. But the question at the media articles, the speculation is all about whether we settle at 15, 16%, or we settle at 20, or we settle at 25. This is anybody's guess. But broadly, as we see, the key allies of US who have been natural allies like Japan, Korea, UK, those have been inflected with rates of 15%. Majority of the Asian economies, which are more comparable to us, they are in the zone of 18, 20%. So the likelihood of those final number being closer to 18, 20 is much more than being closer to 15. But again, this is just numbers as they stand. Any kind of guesswork, any kind of estimate would be like speculative. But it's just our understanding as to where others peer sets are standing. We would await the announcement to see where the trade deal actually gets signed. And but yes, once the trade deal gets signed, that would be meaningfully positive for the markets.
Sure. Of course, it will be speculative, 18 to 20%. But if that is the final level, would you still say that it's discounted, or would you say that that would open up another door for a big rally in terms of the
No,
market expectation?
it's for big rally. So I don't see that being majorly discounted in the markets. There is a lot of nervousness around it. So I don't see that being discounted.
Okay, that's not being discounted. Got your point. But the final few questions, I have a whole lot of them, but I'll just restrict myself to two more. In terms of finding alpha, which are the top two sectors that you foresee giving good returns over the next 1 to 2 years?
So I would go for capital markets and platform oriented companies.
All right, platform oriented companies and capital markets. And which are the sectors that are complete avoids at the current juncture? I think one you said was oil PSUs, but aside of that, any other sector which you feel is overhyped, or perhaps valuations are too expensive there and doesn't really match up? Anything that comes to your mind when you say that this is something that that should not be part of portfolios?
It's predominantly FMCG and large cap IT.
All right, FMCG and large cap IT. All right, that's the view then. With that, Alok, would like to thank you for taking our time and joining in. A good conversation, and I hope to have more of that in future. I'll save all my other questions, other sector related questions for that time, but appreciate you joining in this morning. Lovely chatting.